Good afternoon. Thank you so much for joining me this afternoon on getting to grips with your balance sheet. Not the most exciting topic I can appreciate, but I'm sure by the end of it, you're going to be so much more excited about your balance sheet. Have you all filed your GST returns, by the way?
No.
Yes.
No. Thanks for that prompt this morning, Hayley.
Yes, I'm still trying to get mine out, and that's because I took 5 days off over Labour weekend. So my own fault, really. So let's kick off. So you all know something about me. We are finalists this year in the New Zealand Zero Awards, so that's really cool. I get to go to a fancy party, and that's all I really care about. And we're also Certified Bookkeeper of the Year, and we're heading away to conference. Are you coming to conference, Kate?
No, I can't make it this year.
Stank.
Yeah.
So we work with companies doing financial accounting, bookkeeping, and business development, business planning, strategic planning, all of that sort of stuff, as well as businesses in financial difficulty. So we help them negotiate with inland revenue. So today, rules of the game, 100% participation. It's essential that, you know, we participate to actually maximise our learning. There is no dumb question today, and in fact, I'll probably ask quite a few myself. So, you know, if you're thinking it, say it, because you can guarantee someone else is. Dream big, even though that your business may be small or it's not relevant to you now, some of this information will be relevant to you in the future. So actually think about what could your business look like in future years. And have fun. Life is too short. I prefer to do these types of meetings because then if I see you going to sleep, I know that we need to do something to bring you back and entertain you more. So today, really small group, so feel free to just jump in, ask questions. The more you ask, the more benefit you're going to get out of this. If you don't want to ask a question, you can actually put your hand up using the Zoom function, or put in a question in the Q&A box, or just throw something in the chat box. So today, the secret of change is to focus all of your energy, not fighting the old, but building the new. And quite often in business, we will actually be caught putting out fires all the time. And so we don't actually look forward. We're always looking backwards. So today's session is about building a better balance sheet, which can seem quite technical and a bit daunting, but stay tuned because you'll get clearer on the power and the opportunity that lies within it by the end of our session. So before we get stuck in, I just want to throw in our usual disclaimer that the information in this educational webinar is of a general nature. It is not a substitute for any specific tailored advice for your business. This is pretty much just a generic overview. Today, we're going to talk about the balance sheet, what the balance sheet tells us. And so there's going to be some formulas and things for you to actually work out on your own balance sheet. Practical and proven strategies for a stronger balance sheet. 4 most important areas of focus. Maximising your business value. Best practice for every business, and then your next steps. So let's get into it. It's time to talk about the balance sheet. So often we see business owners and consultants, they focus all the energy on the profit and loss statement. They're always looking at ways to drive up revenue and drive down costs, and what they're looking at is that bottom line. So I don't know many businesses, and considering the number of people that are actually here today, I think this is evidence for it, they don't see the value in the balance sheet. So while the profit and loss is important, unless there is a focus on the balance sheet, profitable businesses can and do go broke. And being where I've come from inland revenue and it's insolvency, I can tell you now, we've had really good businesses go under just because they don't have the cash. So, for example, if you drive up sales but don't have a great system for invoicing your clients or collecting the money owed, the business can run out of cash. Likewise, a growing business can overinvest in stock, and then in a downturn, like what we've got at the moment with COVID, then they find it difficult to move the stock and convert it into cash. So cash is often described as the oxygen for the business. There are many ways to increase cash flow, which we'll talk about, but the balance sheet is where your cash is measured. So profit and loss, that's money in, money out. Your balance sheet is where your cash is shown. So just as your bank looks at your balance sheet when they decide if they're going to give you money or not and to see if your business is solvent, you should be looking at your balance sheet as well. Trading while insolvent is not only extremely stressful because you'll find it really difficult to pay the bills, and we will explain what that actually means, trading while insolvent. It also potentially puts you at personal risk with creditors. So often you will have a personal guarantee, and if you don't actually pay your bills on time, then they can come after your personal assets. So this is where the balance sheet is really critical. The tax department and financiers and creditors are all very much focused on your balance sheet. So we're going to show you today how to test at a glance if your business is solvent. So you will know really quickly whether or not you're in the right position or not. In a downturn, it's important to make sure you're not drawing too much out of the business for personal spending. So we're going to focus on that today as well and just show you how to manage that. Tax bills generally lag behind the revenue that you're generating. So you could find yourself in a position where a surprise tax bill can't be paid because you've taken too much out of the business. So a personal budget update is always a good idea. So having a war chest of cash is essential in times of economic downturn. So if profits are down or if you're making a loss, a strong balance sheet can see you through until profitability is restored. So what I mean by that is, if the profit and loss is money that's flowing in and out of your business, so this is my income, these are the bills that I need to pay, and at the bottom of that profit and loss, this is how much money we've made. The balance sheet, which they often refer to as a statement of financial position, actually outlines this is how much money you've got in the bank, this is the value of your assets, these are all your liabilities, and at the end of the day, this is how much you've got left in equity. So we'll go through and explain that a bit further on, but the two are very different. So what the balance sheet tells us, like I said, also known as Statement of Financial Position, it provides a snapshot of your business's financial position at a specific point in time. A profit and loss can go for, say, 2 months, 3 months, a year. Your balance sheet is one day. The position is at that one day. And I sort of liken it to if you've got a family reunion and everyone comes together for one day and you take a photo, that is everyone that was there on that one day. You cannot go and take that photo the next day and expect everyone to be there again. So it is a constantly moving position, because as money goes in and out of your bank account, and as you buy and sell assets, and as you get loans, your balance sheet changes on a daily basis. The balance sheet measures the net worth of your business, so which is your assets less your liabilities. It also shows if your business is solvent, and if your liabilities are greater than your assets, then the business is insolvent and urgent action is needed to fix this. So obviously, what I mean by that is if you've got more loans than you do have assets, then you are trading while insolvent, and we've got to fix that. You can also compare different periods. So whereas I said that the balance sheet is 1 day, we can compare this 1 day to that 1 day the previous year. So we can see, are you on track? Are you going up? Are you going down? And we can actually start seeing trends so that we can manage your business performance. And it also provides a basis to calculate key ratios such as debtor days, inventory days, and working capital. So right now you're probably all thinking, I don't understand a word you said, so let's jump in and have a look at it. Here we've got our imaginary building company. And so the first part of the balance sheet is the equity or owner's interest. So you can see here that this company made a profit of $71,504 last year. But this year it's actually made a loss of $45,857. Total equity, which means if the company makes a further loss, it will be insolvent. So you can see here that total equity, $47,944, is what we had at the end of 31st of March 2019. We've now made a big loss, $45,857, which actually has eaten away all of our equity from the year before. So now all we've got in the business is $2,087. If we go and make another loss in the next financial year, we will be insolvent. So we need to fix this up fairly quickly, because at the end of the day, our equity is what we've got left from our assets minus our liabilities. Am I making sense? Yeah, it's okay to say no. So we're going to build out this balance sheet so you can actually see how this actually works. So that's our equity. The company has a bank account. So this is our bank account. Last year we had $200 in cash. This year we've got $11 in cash. So you can sort of see that we've sort of gone backwards. We're starting to run out of money. And this sort of information we're not going to find on a profit and loss, because profit and loss is just money in, money out, and it is just income less expenses. This is where we're going to know, are you guys performing financially? So you'll also see here that we've got income tax receivable of $5,375. So what that actually means is that this company, our building company limited, has actually paid out too much tax in the previous year. And so that's going to kill their cash flow because they're paying money that they didn't actually need to pay. So the opposite can actually happen too, though, when we're doing quite well and then we end up landing a tax bill that we can't pay. So this is where your balance sheet is actually really important to keep an eye on what's happening. Having a regular update of your tax position throughout the year actually helps to make sure that you're on track and that you've got the money put away. So if you can, have a chat to your accountant and see if they will actually update you a couple of times a year so that you know exactly where you're actually at with your taxes. So tax refund means too much tax is being paid during the year, which is a drain on cash flow. And now we're going to, so you can see here, we've now got the equity and now we've got our current assets. Sometimes equity actually goes at the bottom and assets are on the top, but they all mean the same thing. So inventories, you can see stock on hand has increased by $33,862. So that's a further drain on cash flow because there's a lot of money tied up here in these stocks. Holding too much stock can actually put pressure on a business, as that stock first has to be sold so that we can then collect the money from the debtors. On the flip side, work in progress has actually reduced by 47,000, which is good news, as the higher the amount tied up in unfinished work, the longer your cash is tied up for. So this is, your balance sheet is all about your cash and where your money is coming from. So in this example, work in progress is the value of wages paid on a job that you cannot yet invoice out to customers. So if you can think of that, in 2019, we had $63,000 worth of work that we'd actually paid out wages on and couldn't get paid. Whereas in 2020, we've only got $15,000 worth of wages that we can't get paid for yet. So cash in the bank, much better. And now the old favourite, the shareholder advance account. This can be a shareholder current account, it can be a shareholder account, it can be a shareholder advance account. It just depends on what fluffy words your accountant likes to choose to use, but it's all the same thing. It's money that either the business owes you or you owe the business. At the end of the day, in this case, this is an asset. The shareholder advance account is an asset, and that is because the directors of Building Company Limited, the shareholders of Building Company Limited actually owe the company money. They've taken out too much money and now they owe the company $66,000. And so you'll see here in 2019, it was 33,000. Now they've doubled that and now it's 66,000. The way that that happens is they take drawings, and you'll remember from the beginning that we had a big loss. So therefore, they've taken out drawings. There was no profit to allocate them as shareholders' salary. So all of that money that they've taken out of the business goes against their current account. And so because they've taken out this money, they've taken out too much, and we now need to pay back the company. So this isn't good, because if the company fails, a liquidator or receiver can demand this money from the shareholders, and they won't have the protection of the limited liability and will be personally liable for this money. As an example, when I worked at Inland Revenue, we had, hang on a minute, I've just got to invite these guys. As an example, when I worked at Inland Revenue, I had a company that hadn't paid, it was about a $300,000 GST debt. Their overdrawn current account was $1 million. I very quickly sort of said to them, look, I'm going to liquidate your company, and that way you can pay back your $1 million and we get the $300,000 GST debt, because there's plenty of money there. They paid that very, very quickly. The risk of having an overdrawn current account is absolutely huge. So really keep an eye on your balance sheet. If you don't look at anything else on your balance sheet, your current account is critical for you and your protection. Any questions on that one? Like, I am very hot on the whole current account thing. No. Well,
do you mean like your current account, like your current account as in that's your business account?
No, as in the money, so it's got nothing to do with the business bank account. It is money that you've given the business, and it is, the best way to describe it is you go to BNZ and you open a business bank account and you funnel money back and forwards through the business bank account at BNZ. Your shareholder advance account or your shareholder current account is you are the bank. So instead of actually having BNZ, you're the bank. And so now we're just funneling transactions between the two of you, the business and the company, the business and you as an individual. If you give the business more money than you take out, then the business is obviously going to owe you money. If you take out more money out of the business than what you've put into the business, then the company's you will owe the company money. Does that make sense? I think I just confused myself. If you put in more, the company owes you. If you take out more than what you've put in, then you owe the company. So it's exactly the same way. If you take out money at BNZ and you're in overdraft, then you've got to pay the BNZ. But if you've got a savings account and you've put in money, then the BNZ need to pay you the money.
Yeah, great. That was kind of the question I was emailing you about, actually. So that's great. I'm glad I clarified.
Cool. So when we also look at accounts receivable or debtors, so you'll see here our accounts receivable, that's gone down, but cash is tied up in debtors for 48 days. So if we can free up some of that and actually start collecting these debts sooner, then we're going to get more money in the bank, which then means that we can operate a lot more smoothly. So that is, and then we've got our non-current assets, which is goodwill. So you get goodwill if you actually buy someone's business. There's very little value tied up in fixed or non-current assets. So you'll see here that the fixed assets are dropped by 23,000. So that could actually mean that we've got some assets that are due for replacement. The vehicles might be getting older, which means that we've probably got a future drain on cash reserves when assets need replacing. So we need to keep an eye on these figures. It's not just all about depreciation, it is about actually planning the way forward as well. So also, although the total reduction in total assets this year is only 15,000, the reduction from 297 down to 282, the 297 down to 282, is actually boosted by the fact that we had that overdrawn current account. So if we didn't actually have that overdrawn current account in there, because remember, we owe the company money, if we actually exclude that, our assets have actually dropped by 48,000. So it's important to remember the true asset reduction value, because this is where we're going to start seeing a really good example of the business's projection and the fact that this one's going downhill in assets. So that is all of our assets. We've got our equity, we've got our bank accounts, we've got our accounts receivable and our work in progress and our stock, and then we've got our physical plant and equipment. So let's now take a look at our liabilities. So you can see here that the Visa account has increased dramatically. So that could be a real symptom of poor cash flow. Credit card accounts need to be cleared in full each month to avoid the high interest costs. So if you're unable to pay your credit cards each month, it's important that you talk to your accountant about what you can do to restructure those things. So here we've got the bank overdraft. So, and I know that this is an overdraft here because it's a liability. If this was a asset, this would be an account with credit. But because it's a liability, it's something that we're liable to pay for, then this is an overdraft. So that's increased from 36,000 to 38,000. So once again, that's telling me that this business is running quite close to the limit throughout the month. Often the most difficult time of the month for cash is not the last day of the month. For example, it might be the day wages or payroll taxes are paid. So we need to make sure there's a buffer of cash in the overdraft. So we need to actually fully control what's happening in our overdraft. A useful measure to see is if the overdraft is reduced to zero at any time during the month. If the overdraft for this company never goes below 20K, then that 20K is to be considered core debt and should be refinanced to be a business loan. So if you can imagine an overdraft, you're probably paying 13% interest. If we've got a $38,000 overdraft and we can never get this below 20, there is no point in having a $38,000 overdraft. We could actually take 20K of that and put it into a fixed term, put it against your mortgage, do something, restructure your finances, pay, at the moment, 3% interest is so much better than paying 13%. So really think about what you're doing and how much interest you're paying. And this is where you're going to get this information is from the balance sheet. So then we're going to have a look at the GST. So GST is a lumpy expenditure. And what I mean by that is that's going to go up and go down depending on how much you're spending and how much you're earning. So it's not generally payable each month, but on your balance sheet, it's always going to tell you how much you've got to pay. If, big disclaimer here, if you have done your reconciling. If you haven't done your reconciling, then there's not going to be a true value here on your balance sheet. So a good strategy to preserve cash flow is to put aside a set amount each month for GST. So once you've done your GST reconciliation of your transactions for the month or the week, jump into your balance sheet, actually see what the GST payable is, and just make sure that that figure is actually in a bank account somewhere. So it is highly likely that you won't end up paying that money, but always put that money aside so that it's actually secure and ready and available when you do need to pay it. So I've already talked about using the bank account for this purpose, like set up the different bank accounts and actually transfer money in. If you've got employees, you may actually want to have a separate bank account that you could put away holiday pay liability, and so that you've got a bank account full of holiday pay money when your staff are ready to take them. Helps with cash flow. So you'll note here that last year, okay, I'm just reading comments at the same time, so I'm trying to double. If you talk, so you'll note here that last year the tax payable was $15,747. And if you remember that this year there's a tax refund owing, and that's due to that big loss that the company's now actually had. So by having regular updates of your tax position, large fluctuations in tax payable can be avoided. And this could actually go the other way. Imagine if you'd had a $45,000 loss and then actually ended up with a $54,000 profit. That's going to be a huge tax bill that you're not prepared for. So by keeping an eye on your balance sheet and your profit and loss, you're going to actually have an understanding of what you need to have put aside. And just a quick note that there's a loan here for a phone, bearing in mind that this phone loan possibly isn't on large, it's probably interest-free. But let's say, for example, that asset finance is incredibly high when it comes to interest rates. And so we might actually look at doing things differently. Instead of actually paying high interest rates, we would restructure and move our finances around to get the best practical position that we possibly can. So really consider finance deals, because once again, that's a liability on your balance sheet when you actually go and sign them all up. So I've just got a question here regarding intangible assets, goodwill. So for example, if we go for independent valuation for our business, or say for our accounting business, then we're able to show that valuation in balance sheet. Yes, so goodwill, bearing in mind that I'm not giving you any financial knowledge or approval or anything here, I'm just saying goodwill is normally shown on the balance sheet. So that's where you'd find it. And why you likely won't pay GST is if you are spending more than what you've got coming in, then IRD is going to pay that back to you. So if you can imagine, you've got more money leaving your bank account than you have more money coming in, then IRD is going to pay you the GST that you've paid over and above what you've received. If you're receiving more than what you're paying out, then you need to pay inland revenue for the difference between the two figures. Does that make sense? Cool. And here we've got trade and other payables. So this is probably the biggest example of cash strain. The payables have increased from 72,000 to 111,000. If we refer to the trading accounts cost of sales, we can calculate that, and it's taking us 74 days to pay our suppliers, and that's up from 47 the year before. So that's telling me that there is not enough sufficient cash to pay suppliers each month. So this business owner is probably incredibly stressful. Sorry, the business owner is not stressful. They're probably really stressed. And they may be looking at, you know, doing things that possibly aren't the right thing to do. So really actually look at these figures, because this is where you're going to know exactly what your position is. So we're going to have a look at calculating some of these shortly. And so here you'll see that we've got, the company has refinanced a loan, 98,000. They've obviously paid off a little bit and they've refinanced it down to 96,000. This is going to incur potential legal costs and loan application costs. There's costs associated with doing this sort of stuff. And when we look at it, the net assets, so this is our assets minus our liabilities, we've only got $2,087. The company has got no ability to borrow any further funds, because if it does, it's going to fail the solvency test, because our liabilities will outweigh our assets. So we're going to go into this more shortly. So with the reduction in net assets of over 45,000, we need to be thinking about how we can bolster this balance sheet and start reducing some risk. So let's have a look at this. In the current climate, it's likely that many balance sheets would have actually taken a hit because of COVID. So what's important is to focus on what you can control and adopt practical and proven strategies to bolster your balance sheet. So what that actually means, we're going to focus on 7 ways to grow a business. So once again, increase customer retention. Actually focus on your customers, because they're the ones, if you can keep them coming back, then you're doing well. Build a plan to delight your clients, under promise and over deliver to them, so they refer more customers to you and they don't defect to your competition. To generate more leads, focus on your marketing, and especially via referrals, testimonials, social media, as these are all relatively cost-effective strategies. To convert more prospects, So do you understand what I mean by to convert more prospects? We've actually got them in, they're wanting to talk to you, they're learning about it, and now they're going to actually turn into a sale. So they're now going to give us money. That's converting our prospects. Look at strategies that will increase your proposal or quote acceptance rate. So perhaps some sales training could be in order. If we're not doing some converting, then we need to look at that. And I think I spoke to someone once and they were like, oh, I'm so over the moon, my conversion rate is 10%. We don't want 10%, you know, we would like 50, 60% conversion rate. So really actually focus on what it is that you guys are converting. To increase your transaction value, so implement strategies to encourage customers to spend more with you every time they buy. So you've all been to McDonald's and it's like, would you like fries with that? You know, this is called increasing your transaction value. So if you are a plumber, you know, it might actually be, would you like a nice smelly to go in the toilet when I've finished? Or, you know, add in that extra little service that you can add to your product and increase the value. Increase the transaction frequency. So if you've got people staying, buying with you, say, once every 6 months, what happens if we can bring that back to once every 3 months? Then suddenly, instead of getting 2 sales a year, we're now getting 4. So think about how we can actually keep in touch with our clients. It might actually be that they buy something big from us once a year, but can we actually do something little just to keep them communicating with us and buying little things? And it also means that you're staying in contact with your customers so that you're always front of mind. If they need you, they're coming to you. Reduce your variable costs. Identify strategies to eliminate waste and rework. Tradies especially, quite often, you know, something will go wrong. They end up having to go back and redo a job. They don't factor in that redo time into that original project cost. And they also don't back cost the projects, like they quote it and then they go out and, yep, this is what it is, this is the amount of money. They haven't back costed what it actually costs them to do that job, including rework. So highly recommend back costing, because then you'll get an idea whether or not you're doing the right thing or not. And finally, reduce overheads or fixed costs. So review these at least annually. I've said this before. Once we had a client that was paying for his ex-wife's life insurance and hadn't realised for 3 years. So actually go through and do those checks. You know, if more of your team are working from home, can you downsize your office space or reduce rent? Can you get a better deal on your power or your phone? It is important to be careful though that you're not cutting the fat, that you're cutting the fat out of your budget and not the muscle. So don't go and try and cut costs on things that are actually really making a big difference in your business. Only take out the stuff that's not. Some overheads could be seen as investments, for example, investing more in your accountant, not saying anything, to help grow your business. So don't take away your support just to save money. Seriously though, if you see your accountant as a cost, then you should be cutting them like all costs, because your accountant is there to actually support you and educate you and give you everything that you possibly need. So if you don't feel that you're getting value for the money that you're paying, then definitely go and see if you can cut costs or find that support that you need. So improving cash flow. So the second area of focus to bolster your balance sheet is about building profitability. So the cash conversion cycle, and I know we've covered this before in our cash flow one, but let's do it again. Cash conversion cycle, day 0, we buy stock from the supplier. Day 35, we've got to pay for that stock. So we've had the stock for 35 days, and at this stage, this is when the money actually leaves our bank account. At day 65, we're finally able to sell that stock to a customer. So it is average stock holding days of 65 days that we've got this stock sitting in our shed or on our shop. And then obviously we sell that on credit, and so then 110 day, we then actually receive payment from the customer. So at day 35, the money left our bank account. Day 110, we actually got the cash into our bank account. So that means that our cash conversion cycle, 65 days, so day 35 to day 110, sorry, 65 days from here to there, plus 45 days, which is the accounts receivable waiting to get paid, minus the fact that we didn't actually pay the money for 35 days to start with, means that our cash conversion cycle is 75 days. So let me just explain that again. 65 days, we were holding the stock on our little shelf. And then it took another 45 days to get paid for that stock that we sold. However, in that 65 days, we still had the money in our bank account for 35 days. So we can take out 35 days because we still had the money. So if we sat here and worked out what your cash conversion cycle is, and it might be tradies are exactly the same. They may not be buying stock, or they might be going down to Mitre 10 and buying timber. They are still got a cash conversion cycle because they've got to pay for that timber. They've then got to put the timber into the building. They've then got to finish the job, do the invoice, and then get paid. So their cash conversion cycle could potentially be quite long. So it's about actually having a look at tradies as well. Even if you are a service-based business, you will have a cash conversion cycle because you do the work before you get paid. So if we actually sat here and went, okay, yep, cash is king. We've got to focus on your supplier terms, inventory or work in progress, and debtor days. So we're going to go through how this actually works. And this is recorded, so you can go back and play this and work it all out using your own balance sheet. Here we've got our building company limited. So he's got stock on hand 57,000 in 2020, and 31st of March it was 23,635. So to do this, we can see that inventory is taking 38 days to sell. So here's the formula: stock on hand, divide that by the cost of sales for the year, and times it by 365 days. In 2019, our inventory days, so what this means is that our inventory is actually turning over a lot faster in 2019 than what it is in 2020. So if we can reduce our inventory days by 9, so if we can sell these stock a lot faster and reduce it by 9 days, that then puts $13,000 back into our bank account. And so no one would have actually thought that having that stock on our shelves for 9 days less is going to actually give us 13 grand. So now if we're going to look at our work in progress, let's have a look at that one. If we can say, so the work in progress formula, work in progress, 15,000 in 2020, 63K in 2019, work in progress, divide that by the cost of sales, times 365 days, and you'll see there that the work in progress is 41 days in 2019, but we've improved it, and it's now down to 10 because we didn't have all of that work in progress sitting there, if you remember from the balance sheet. So if we actually improved our work in progress, sped up our efficiencies and actually got everything done a lot faster without rework, then that actually frees up a lot of cash. So you can see here in 2019, if we reduced our work in progress days by 25, that's $38,000 in your bank account. So it's a lot of money when you actually start thinking about little things that you can do to actually help. And now this is the one that no one ever thinks about, debtor days. How long do people take to actually pay your bill? So debtor days have been pretty consistent between 45 and 48. That's not really changing. But if we can improve the debtor days by 18, and what I mean by debtor days is you've sent out your accounts receivable or your bill to Joe Bloggs, and at the moment it's taking Joe Bloggs 48 days to pay you. If we can do something to get Joe Bloggs to pay us 18 days faster, that's going to free up 31K in cash. So all that actually is making sure that we're actually chasing up our debts and making sure things get paid and doing things more regularly. And then that means that we're going to have more money in our bank account. Does that make sense, or have I just lost you completely? Cool. So the formulas are here. Debtor days, debtors, so that is accounts receivable. Divide that by sales times 365. So once you've sat down and re-watched this, sit down with your own balance sheet and actually run these formulas year on year and actually see how you're performing. Are you improving? Are you going backwards? What is the actual story that is telling us? So you can see here we've got inventory days, we've improved those, WIP days, debtor days. So there is a potential there of $52,000 in cash. In 2019, just by actually knowing what was happening in our financials, by understanding what the balance sheet was telling us, we can actually save $91,000 potentially and get that money, 91K, into our bank account. So there was huge benefit in actually running these equations and actually seeing what you can do, because to reduce debtor day is not actually that hard. Any ideas what you would actually do to reduce a debtor day? You're muted, Katrina.
I don't know, but it doesn't really apply to me because they pay at the time. But I was thinking like some places do like prompt payment discounts.
Yep. Yep. So, and it is about actually having that relationship with your clients. It's about having clear terms of trade. My terms of trade are 7 days. And actually, if your terms of trade are 7 days, then and they don't pay within 7 days, it's actually okay to pick up the phone and say, hey, you haven't paid me, and my terms of trade are this. Just because people don't pay you doesn't mean that you then have to sit back and wait for 90 days for them to pay you when they're ready. So the key thing here...
Can you say fee on top of that if they don't pay
within that
7
again?
days? Or is that a bit aggressive? Just if you then say, you know, 7 days, after 7 days you get, say, I don't know about 10% per day, but, you know, let's say 1% fee every day that you're late. Is that not a bit aggressive?
I think that's possibly a little bit aggressive and wouldn't build a very strong customer relationship, if you know what I mean.
Yeah.
Because, you know, it's about it's about, we want to foster that relationship and we want people to want to work with us. And if we're going to go and slap them with a cricket bat every time that they do something wrong, they're probably not going to want to work with us. So it is actually okay to pick up the phone and go, hey, just a reminder, I'm a small business owner. It would be really great if you could help out and just pay your bill, or just a portion of it if you're struggling. But don't just sit back and do nothing. And like Sanju said, set up automatic reminders. Xero does that automatically for you. So there's a whole bunch of stuff you can do, but reducing debtor days is going to help you with cash flow and make you more solvent. The key thing here is that life will be so much less stressful for the owner of the company not waiting so long to be paid, because then once they've been paid, they're able to be able to pay their suppliers on time, which those suppliers are then going to be able to pay their people on time. So as you can see, it's a real big flow-on effect. Accounts payable, exactly the same way. So we want to look at this and know exactly where we're at. So you can see here, 47 days, we're now up to 74. This is a business that is struggling with cash. They don't have the money to be able to pay things. If we were able to reduce these down by 30 days, it means that we're going to need an extra cash flow injection of 45 grand. So if we got $45,000 extra, then we can reduce down our creditor days by 30. So what that actually means is, here's all the money that we can actually save with our inventory days, our work in progress days and our debtor days, 52,000. To actually improve our creditor days, which is money that we have to pay others, we need an extra 45K. So overall, we've improved our business and we've actually got an extra $7,000 in the bank. 2019, however, we've got an extra 45,000 in the bank. But considering we had that great big huge loss, that extra money would have been really handy. I'm always wary when I talk about this sort of stuff because it just loses people. So to recap, our first strategy was to build a profitable business, and the second is to improve cash flow. Now we're into our third area of focus to improve your balance sheet, which is to maintain solvency. So as mentioned, there are two components of solvency, often referred to as the first and second limb. The first is the ability to pay debts as they fall due. So if you've got a $100,000 bill come in, can you pay that $100,000 bill when it's due? And then the second part of the test is ensuring that total assets are greater than total liabilities. So not just the current assets and current liabilities, it's total assets and total liabilities. So let's look at this example. So you'll see here, total assets, 227,000, total liabilities, 174,000. So in this case, this company is solvent because it's actually got a ratio of $1.31 for every dollar of current liabilities. Last year it was $1.55. For every dollar of liability, they've got $1.55. So this is it here. Current assets minus current liabilities gives us our current ratio, meaning that we're doing okay. Now, you know how we spoke about this whole shareholder current account, how you owe the company money? If we take that out of the picture, suddenly we're no longer solvent. So we've now got 92 cents for every dollar of current liabilities. So therefore, we can't actually pay our liabilities because we've only got 92 cents. Does that make sense? So this company now is technically insolvent because we can't, we can't include the money that we owe the company as an asset. To fix this in the long term, we need to go back to our first strategy and increase profitability. For the short term, the company either needs a cash flow injection from the shareholders, or part of that bank overdraft needs to be converted to a term loan. So I'll talk more about the shareholder advance account shortly, but let's just look at the second part of the solvency test, total assets greater than total liabilities. Which one's that one? Assets greater than liabilities. So you'll see here, total current assets 174,000, and it's leaving us with $2,000. The company needs a short-term cash injection of at least 66,000 to actually clear up that shareholder current account. So by doing this, we're able to add in, so if we add in $70,000 in a short-term loan, we can now eliminate the bank overdraft and the shareholder advance account becomes a liability of 3,506. So you see down here, we owed the company money, we've put in 70K, but the difference between that figure and this figure is now the amount that the company owes us. So we owed the company money, we've actually given the company more money than what they owed us. The company now owes us that difference, 3,506. So managing the shareholder advance current account, some things to, the shareholder current account is my key thing. If there is nothing else that you take away from this, it is that current account. And I've seen so many businesses go belly up and so many people go bankrupt just because of the shareholder current account and they didn't know what it was. So I've covered the risk associated with overdrawn shareholder advance accounts. The main risk that is if your company gets into financial difficulty and a receiver or liquidator is called in, your personal assets are at risk. And that will mean that you've got to pay back that loan to the company. So a great way to avoid an overdrawn shareholder current account is to update your personal budget so that you're only taking out of the company what you actually need to survive. Personal budgeting is a rewarding and empowering thing to do, especially in the current climate. I think, my businesses that have actually been really successful through COVID are the ones that have actually been able to balance their budget along with the amount of money that's coming into the business. We had a cash injection sitting there, and so it was actually all good. So while we're on the topic of personal budgeting, set a regular weekly or monthly amount that you take from the business and stick to it. In saying that, if you're doing $10,000 worth of sales and then all of a sudden you're doing $2,000 worth of sales, you really possibly shouldn't be taking your $5,000 salary. So you do need to be able to look at the business and actually go, can the business continue to afford to pay me the amount of money I've always been taken? And when things change. So it's not a case of set and forget. This is the amount of money. Really keep an eye on what's happening in your business to decide whether or not you can afford to keep taking that amount. You might be able to increase it or you may need to decrease it. And lastly, to protect you in the event that the business does get into financial strife, having security for advances you've made to the company ensures that in liquidation, you stand a higher chance of getting your money back. So definitely have a chat to your accountant around that one. I don't recommend having a current account of $350,000 or anything silly like that. So really get an understanding of what your current position is in your business so that you understand exactly the position that you're in. So there's been a heap of numbers and ratios and everything that I've actually thrown at you today, and I don't blame you if you sit there and don't remember what I've actually said. this is recorded, you will be fine. So I've covered a huge amount of detail and some of it's quite technical. The main message from today is that your balance sheet is fundamental in assessing your business strength. There are so many things you can do to bolster your balance sheet, build profitability, improve cash flow, maintain solvency and manage those shareholder current accounts. My aim is for you to take away what you've learned today and implement some positive change into your business. So your next steps, you've got, doing nothing is not an option. Doing what you've always done is unlikely to give you the same results as you've had in the past. So remember to put the oxygen mask on yourself first. You've got to actually focus on yourself and on your own business and know exactly where you're at. When I worked at Inland Revenue, the amount of times I heard, oh, I don't need to worry about that, that's my accountant's problem. My big thing to you is it is not your accountant's problem, it is your problem. Your accountant doesn't care about this like you care about it. So really get your head around it and start learning it. Make a clear plan for the steps that you're going to take to bolster your balance sheet so we know what they actually are. Focus on what you can do as opposed to worrying about what is outside of your control. And COVID, especially right now, has put pressure on people like you wouldn't believe. Focus on what you can do. You're going to be a lot more successful if you're moving forward instead of worrying about things you've got no control over. And at the end of the day, we're here to help you. So if you've got any questions, by all means, sing out. So we've got some options here for you. We can do a balance sheet health check free of charge, just so that you can actually get an understanding of where you're sitting. We also do complimentary meetings, 45 minutes, just for you to ask any questions and get an idea of ideas that you can do. We do run a program and you may be eligible for RBP funding, and that is a 12-week program where we put you through your paces and teach you everything that you need to know about financial awareness in your business, debtors, creditors, terms of trade, the whole lot, and cash flow management. So that is an option for you as well. And, parting thought for the day, business is many things, the least of which is a balance sheet. It is a fluid, ever-changing, living thing, sometimes building to great peaks, sometimes falling to crumbled lumps. And we're going to see that a lot at the moment with businesses really thriving through COVID. Next year, they could be plummeting to the ground. So really keep an eye on your balance sheet and the information that's available in it. So make a simple plan for today. Commit to at least 3 actions that you're going to take away from today's webinar. Now is the time to do stuff. You can't pretend that you don't know the value of the balance sheet, because we all know that you do now. Write them down, give each of them an owner and a completion date. Like, you've got to move forward and make sense of what's available for you in your balance sheet. So, thank you so much. You're all still awake, so that's a bonus as far as I'm concerned. If you had one question to ask, what would it be? And everyone doesn't have a question. So that must mean I've explained it really well, or everyone's really shy and they don't want to say. Sweet.
Is it good to, in terms of, you're saying cash is king, and, only pay when you have to pay. So say, I don't know, 14 days after the invoice, whatever, this is when you're paying for services or paying suppliers or whatever. But if you want to get a better deal, and that's often, they'd like you to pay up front. So is that better then to do that and to keep those good relations as well?
I think anything in business is about relationships. If you can afford to pay and get that better deal and pay up front, there's a real flow-on effect. If you then pay up front, then the person who's going to do the work for you can then actually pay the people that have done work for them. And so it's sort of like, if you can do it, then do it. If you can't do it, then hang on to the money. But it's about understanding what is best for your business.
Cool.
Does that make, have I actually answered that question?
Yeah, no, it's, yeah, you have. Thank you.
So, yeah, so I know this is actually a really technical one, this one, but there is a heap of information sitting in that balance sheet that you should all actually really be focusing on. It's really exciting to actually do things and learn exactly what's happening and actually see how your business is performing. So don't forget, next month we've got the fabulous Fiona Fraser joining us to talk about sharing your story and getting it picked up by the media. She has got some amazing knowledge and has worked with Women's Weekly and all those sorts of magazines for quite a few years. So listening to her speak is actually really awesome. If you've got nothing on, definitely register and come along. It won't be a presentation style thing. It is actually going to be a discussion. So come along, ask questions, tell us your story, and let's actually see how we can actually help and educate everyone. So on that note, thank you so much for giving it up. Yes.
Oh, sorry. So just really quickly onto that, just with the GST and more in the balance sheet. So you basically, when you're paying for things, pay plus fee, and like, where does that fit into the balance sheet?
So the balance sheet will either be a liability, so that's money that you owe inland revenue, or it's going to be an asset that the inland revenue owe you money. And so on a daily basis, as you do your reconciliations and things like that, that's going to change its location on the balance sheet. So
you would put the final amount rather than just when someone advertises something like for say $100 plus GST, so into your or your P&L or whatever, you put the $100 or you put the $115?
So GST is not reflected in a profit and loss. So there is no GST on any figures in a profit and loss. And the only mention of GST is how much you need to pay in the lump sum, either in a negative or a credit. So GST is completely separate from your financial account. Check out there is a webinar on my website, and it is Understanding IRD and Tax, and we cover all GST and everything in there and how that all works out.
Okay, sure, I'll do that. Thank you.
Cool. Just before we go, I just want to ask, what was the main benefit that you've actually gotten out of today? Feel free to just put it in the chat session if you don't want to tell me. Just feedback is really good, and you will actually receive an email from me actually asking for feedback. I am at the moment planning our 2021 education program for next year. We won't be running sessions in December, January, because let's face it, no one cares about me during December and January. And we will be back running our education sessions in February. So if there's any information or any feedback you want to give me, definitely do that, because we aim to support as many small businesses as we can.
My main takeaway was about the current
account
and the fact that's the crucial thing, is to look after and manage the shareholder advance account. So that was, for me, like, helpful to know about that.
Yeah, and that's, if there's nothing else that you took away from today, the shareholder current account, that is where I see people getting into trouble. That is where people don't actually understand. If I just go down the road and buy coffee every day and the business is not making any profit. And we do actually cover that off in the understanding financial accounts. So definitely check that one out as well, because that actually shows you how to work out what your tax bill could actually be by actually reading your profit and loss and knowing exactly what your money is going to do and how much your tax is going to be. So definitely check those ones out. But if you haven't registered for next month, then understanding financial accounts and understanding tax and inland revenue.
Okay, cool.
So yeah. But yes, so if you haven't registered, make sure you register for next month. It's promising to be, I'm really excited about this one with Fiona, by the way, if you haven't worked it out. But thank you so much for giving up your time once again. I really hope you've received value out of it. Enjoy the rest of your afternoon.
Thank you, Hayley. That was great.
No worries. Catch you later.
So much.
Bye.
Bye.